Welcome to The Explainer. Today, we're unpacking a really fascinating piece of analysis called the Convergence Brief. But before we dive into the data, I am required to read our mandatory disclaimer verbatim. Let's get that out of the way first. The content presented in this podcast is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional. This audio/video podcast is an AI-generated product, produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. Copyright Reflections of Reality. All original content rights reserved.
All right. Thanks for bearing with me. Here's our roadmap for today. We're going to start by looking at our two lenses, then dive into lens 1 to see the priced regime, and lens 2 for the tactical tape. After that, we'll bring them together in the convergence synthesis, and finally, we'll talk about why the gap is the trade.
Let's kick things off with Section 1, two lenses, one horizon. To truly understand what's happening in the market right now, the Convergence Brief tells us we can't just rely on one perspective. We need two very different lenses that share the exact same swing horizon. Lens 1 is the Polymarket Macro Monitor. This gives us crowd-sourced, event-driven probabilities, basically what the crowd is betting on. Lens 2 is the Weekly Market Intelligence Brief, or simply the weekly report. This uses a strict flow and breadth machinery to measure tactical, real-time market signals. The goal here isn't to have one replace the other. Instead, we want to read both side by side to find exactly where they contradict each other. That friction is where the magic happens.
So let's look through that first perspective. Section 2, Lens 1, the priced regime. What is the crowd actually pricing in right now?
Well, the most striking takeaway here is just how extreme the crowd's conviction is on the macroeconomic environment. Polymarket currently assigns a massive 88.3% probability to zero Fed rate cuts in 2026. That is almost 90%. It's a huge departure from legacy consensus pricing. What it signals is a higher for permanent regime. It keeps the U.S. 10-year yield anchored near 4.65%, with upside risk pushing to 5% or more. And this zero-cut expectation has big implications, specifically compressed equity multiples and a very strong U.S. dollar.
In that extreme conviction, it doesn't stop with interest rates. The crowd also assigns a 71.5% probability that NVIDIA remains the largest company by the end of August. On one hand, that highlights absolute AI infrastructure dominance. But on the other, the report notes that it amplifies single-stock fragility. If we see any kind of AI sentiment reversal, that extreme positioning leaves the broader index highly vulnerable.
We also need to factor in geopolitical risks, especially looking at the Persian Gulf. The probabilities here show deeply entrenched brinksmanship. There's a 38.5% chance of no U.S.-Iran peace talks by September 30th. There is a 24.5% probability that the U.S. invades Iran before 2027. And there's only a 15.5% chance that traffic through the Strait of Hormuz normalizes by September 30th. So what does this all mean? It paints a coherent picture where energy supply risk is likely underpriced by standard consensus models. The natural implication here is an elevated risk premium for energy and a really strong safe haven case for gold.
Okay, so that's the macro narrative the crowd is aggressively betting on. But Section 3 asks, what is the tactical tape actually doing? Let's switch to Lens 2.
Before we dive into the data, we have to strictly define our terms based on the source framework. When we say accumulation, we mean one thing and one thing only: institutional buying or inflow, period. It's a foundational metric for the portfolio rotation analysis we're about to look at. And when we look at the large-cap portfolio rotation, a very clear winner emerges. Accumulation is the dominant state in the tape right now, sitting at 21.1%. Now contrast that with liquidation, which is way down at just 9%. With rotation in and rotation out hovering around 10.8 and 8.4% respectively, this sheer dominance of accumulation confirms solid, undeniable conviction in institutional buying. A broad-based distribution phase? It's just not visible on the map right now.
Another absolutely critical metric from Lens 2 is the MDI, or Market Dashboard Index. Our authoritative definition tells us that MDI strictly measures overall market sentiment. For context, a score between 10 and 35 indicates bullish mean reversion.
But right now, the MDI isn't in that 10 to 35 range.
It currently sits at 56.00. This places the market squarely in what's called the bullish kickoff zone. Volatility is falling, and the source report specifically highlights that this exact zone offers the best risk-adjusted returns for swing traders. So the tactical tape is remarkably strong.
This brings us to Section 4, the Convergence synthesis. This is where things get really interesting.
The whole point of the Convergence brief is synthesis through comparative analysis. We are looking for exactly where the tactical tape from Lens 2 directly disagrees with the predicted macro regime from Lens 1. Let's look at 3 glaring contradictions, starting with the US dollar. Lens 1, driven by that massive 88.3% zero-cut expectation on Polymarket, implies a very strong dollar because real yields remain elevated. But the tactical tape says otherwise. Lens 2 shows the dollar ETF, UUP, is actually losing bolt percentage, sitting at a negative 24.60 over 1 week. The tape is actively pricing in dollar softness, which completely contradicts the macro crowd's bet.
Contradiction number 2 is a massive disconnect regarding gold. Remember those Persian Gulf geopolitical risks we just talked about? Well, Lens 1 points to a strong safe haven hedge thesis based on that entrenched brinkmanship and supply risk. However, Lens 2 shows that GLD is actually in an outright liquidation state, carrying a bull percentage of only 24.60. So the actual capital flows are sitting very uneasily against the crowd's predicted safe haven narrative.
And finally, we have the most glaring contradiction of them all, equities. Lens 1 strongly signals a need to sell into strength. This is due to the zero-cut environment compressing multiples mixed with that massive tech concentration and AI fragility we saw with NVIDIA. But Lens 2? It reveals a completely different reality. It shows an accumulation-dominant tape sitting comfortably in the bullish kickoff zone. The actual tape is simply not behaving like a market that's bracing for a major correction.
So we've seen major contradictions across currency, commodities, and equities. That leads us to our final section. The gap is the trade. What is the actionable intelligence here? The source document wraps up with this incredibly powerful philosophy. The gap is the trade, not noise. The friction we're seeing between the crowd's macro predictions and the actual tactical flow of capital, that isn't a glitch or an error. Where the map disagrees with the price regime, that disagreement is the exact signal you should be paying attention to. It leaves us with one absolute critical question to ask ourselves. Are you trading the story or are you trading the tape?